The first chart that I'll begin with is Nifty 500. It is a broader market index, and the relative strength line that you see, this is against Nifty 50. So that is the price of Nifty 500 divided by price of Nifty. What you see here is that despite of the fact that recent up move has been really strong, stocks within portfolios haven't done that much. And I'll give you a simple explanation for this. First, look at the relative strength line against Nifty. It is more or less flat. In fact, from the point of July, it is actually down about 5%. That is the RS line. This tells you that, like the US, even in India, the market is relatively narrower. By narrower, I mean that buying is still not picking up in the SMID space, which is the small mid micro cap space, as a basket. There are plenty of stocks in the small mid micro cap space that are doing very well, especially those stocks where relative strength is clearly trending higher. So this has been one theme that we have discussed many a times. Now, if you open up the chart of Nifty 500, I would want all of you to go back and listen to the headlines here in these 2 points. Also at this particular point, I will tell you, because now you see a lot of people making bullish noise about market being at all-time high. We are just 2% away. Bank Nifty is already at all-time high. You need to complete this exercise because you would understand that it is much better to follow charts and data as opposed to opinion, because opinion, as they say, flips too easily. And most of the times on media and social media, you will find opinions changing so soon because they mostly cover the recent price action and they have a recency bias. Now, in this particular episode, I'll just pull out again ETF charts to explain what is happening, what are the pockets that you have to go after, and which pockets in general are offering better risk reward, because that is what my entire focus is when I'm covering any particular sector or market in general. The first thing I'll pull up is the chart of silver bees. So after my last discussion about silver, we've had a vertical fall. I think my last video came out when silver was at 159, 160. We are now getting very close to 50-day moving average. I would still tell you, I will not be inclined to do much in gold, silver still. I would want a proper range to form somewhere here. Let people get shaken out. Let the euphoria die down. Again, it's a lesson for you. Never chase euphoria in the market. Watch out for headlines here, and now watch out for what people are saying here. The same remarks hold for gold. Although for gold, I'll tell you, gold has a structural reason to go up. I still don't think if somebody does not have a exposure to this asset class, they should be getting in today. I don't think the time is right. The sectors that we discussed, PSU banks, look at what happened. Metal, look at what happened. I was late in autos, so I generally did not have a lot of positions here, but only some ETF bets. But banks and metals was one space where I was super bullish, and I had clearly mentioned that these are the pockets that are going to take the market higher. Look at the financial space. Recently, I've started seeing a lot of traction in the infrastructure space also. So this is a fresh base that has gotten formed. Price has rallied. Let it come down a little. This looks like a valid structure. You also look at the EV space. It's very closely linked to the auto sector space. I think the EV space, the battery space, this is again a space that is going to do very well. And of course, with metals, it was commodities. Now, why I opened these charts? Because in the last 40 days, if you did not have exposure to banks, metals, finance, commodities, auto consumption, your portfolio would be flat today. In fact, it would be down because money has clearly moved in this pocket. There are 2 pockets that I had mentioned earlier which did not do well yet. The first is the capital market space. Yes, capital market has seen some traction, but the market regulator came out with some guidelines or maybe some potential discussion points because of which capital market again started reversing. Let's see what happens. I personally feel this is a strong base in capital market index. And even though we can see some volatility, this index will relatively do better. The next pocket that has not done well yet is the defense space. I still remain super bullish on defense. I think defense is forming a beautiful stage right here. It is trying to move up, but I'm still not seeing a lot of names that are getting into the right kind of structure. But these days with the market, the thing is that if you take your eyes off sectors that can potentially do well, you check 5 days later, those sectors have already run up. That is why constantly you have to track sectors, you have to track pockets that are having good risk reward. So I still feel capital market, defense, auto, EV, they have wonderful risk rewards still. Let's come to my favorite sector, which I've been super bullish on, which is Nifty Bank. I think Nifty Bank has a lot of legs to go. That is upward. Today, Nifty Bank is trading at 58,500. I don't know the exact number, but easily Nifty Bank can cross something like 60, 65,000. It will happen over medium term. Nothing I say is from short term perspective. There is some risk that is definitely there in this bull market. I am preparing a video for that. Probably I'll release it next week or one after that. There are certain risks that you have to be aware of that can completely derail what is currently happening. With respect to broader market, I'll just open up the chart of small cap 250 ETF. As of now, you're seeing the traction is not there. I think this can continue, but you have to be careful in not thinking that nothing in the small, mid and micro cap space is moving. So let's say you like a stock that is from the small, mid, and micro cap space. I'll take an ETF to explain this to you. Let me just open up. Let's assume this is a stock. Okay, this is a ETF, Motilal Oswal Capital Market ETF, but let's assume this is a small cap stock. What you have to do, if you find a stock getting into a stage 2 structure and trying to move up, measure its relative strength against a small cap index. So this that you see, this is a relative strength that I'm measuring against Nifty 50. If this were a small cap stock, I would open up small cap index and I would then measure relative strength against it. So something like small cap 250. If I see such a structure that the stock relative strength is improving and the stock is breaking out, I would definitely trade it. Understand this. It is not that the entire small, mid, micro cap space has been cursed and it is never going to do well. There are plenty of opportunities in that pocket that are doing very well. It's just that you have to go behind only those stocks that are breaking out where relative strength is also breaking out. This is a template that you have to follow. But in general, yes, it is true that the market currently is relatively thin. I won't say it is not healthy. In fact, in the last 20 days, I would tell you that the breadth of the market overall has improved. First, improvement in breadth happens and then rally broadens out. So currently you are seeing a lot of stocks in the small, mid, micro cap space climbing above 200-day moving average. The momentum part comes later on. Whether it comes or not, also that is not a guarantee. This is stock market. This is not a fixed deposit kind of instrument where if you make an opinion, that opinion has to come true. If you compute something on Excel sheet, that has to come true. That is not how stock markets work. But the market is clearly divided. If you now look at certain pockets in the market, look at IT. Again, IT remains an instrument for those who have probably a 5-7 year point of view. As of now, there is no opportunity, there's no structure. Look at the RS. RS itself, which is telling you, while NASDAQ is hitting all-time high, this is NASDAQ, look at what our IT is doing. It is heading lower. Yes, there is a lot of talk about AI, but that is a different subject. I don't want to get into it. I think our IT companies will do fine. This is the railways pocket. Again, look at the relative strength. One space that I definitely feel has potential is the public sector pocket. This is the PSE, CPSE index. I'm seeing that there is some bit of double bottom forming in relative strength and price is trying to stage a breakout. So this is again one sector along with defense and capital market that has good risk reward. Okay. You come to health ETF, look at the relative strength not going anywhere. I've covered the small cap pocket. You look at MSCI index. Now this is an interesting ETF from Kotak Mahindra, which is the MSCI India ETF. I think they are replicating the MSCI ETF basket, if I'm not wrong. I'll have to check. But that basket is making a higher high, higher low, which explains why the indices are moving and not all stocks. See, what happens is currently there is more valuation comfort as a basket in large cap as opposed to the SMID space. And which is why fund is flowing more towards large cap stocks, also because FIIs have stopped selling. So that is one potential reason. But in general, if you now look at the total market index, again, you're seeing this higher high, higher low structure in total market. So breadth improvement is definitely happening. While the market is slow, while the market is boring you, there is a lot of underlying buying that is happening silently in market. Now, this is something that I've spoken in almost every update, that market is fine. Have a bottom-up approach. Look at stocks that are breaking out. Look at stocks where relative strength is strong and go behind it. Don't look at indices because indices are currently boring. They don't have momentum. And as such, majority of commentary, if you even look at the festival season update, it came about Nifty hitting all-time high. Nifty hitting all-time high has no meaning for us. Our portfolio needs to move. For portfolio movement, you need your focus towards right pockets of the market. If your focus is towards something like healthcare, pharma, or IT sector, or currently some tourism pocket that is suddenly moving lower, then obviously your returns are not going to be that great. But if your focus is towards the right pockets of the market, which is metal, auto, defense, finance, banks, commodities, EV, infra, then obviously your portfolio will move, because this market is currently fractured. 50% of sectors are taking the market higher, 50% sectors are taking the market lower. And that is why headline indices in general are not going anywhere. There is definitely some kind of a extended move that is happening in the US market. This is the chart of NASDAQ 100, which is currently at 26,000. Very strong relative strength when you compare that with Nifty 50. But as it goes, I generally don't participate a lot in such ETFs because I strongly feel that there is no market in the world that is going to beat India in the next 10, 15, 20 years. Yes, this does not mean price won't correct during certain periods of global volatility. It will, but that will be a tremendous opportunity to accumulate. There is one more ETF I was seeing, that is oil ETF, that is suddenly trying to put in a double bottom in relative strength, and price is also attempting to move up. So there are some names that are suddenly popping up within this sector also. Have a look. There are opportunities provided you go behind sectors and stocks where relative strength is clearly trending higher. There are two types of relative strength you will see in Indian market. One is this, where you're seeing recent improvement and RS is heading higher. One, a sustained kind of up move, which is the auto sector, beautiful consolidation in RS. And then there is a relative strength that looks something like this. This is a clear avoid. This is a clear avoid because everybody has limited capital. Nobody has infinite capital that they can buy everything in the market. That is why you need to go behind those pockets that are clearly trending up. Now, in this market, you also have to acknowledge that not everything is going to go according to the plan. Now, why I say so? Because, right from the point that I had asked people here to look at metal, banks, finance, commodities, later on auto sector also, I was also along the way repeatedly asking you to look at defense and capital market. Now, both these sectors haven't worked. If you look at the tweet I had done, I had also updated here about some ETFs that you have to look at. Only 2 ETFs has worked out of the list of 4 ETFs that I had given. So this is something you have to acknowledge. It's a difficult kind of market where you have to identify 3-4 pockets, make allocations, and then quickly increase allocations in only those pockets that eventually start to perform. So this is that kind of a market. It is not the market that we were all used to between 2021 and 2023. This is the real stock market. That was an illusion. This is a point I've repeated many times. I don't know whether I have the data or not. Let me just try and pull it up. I don't know how many of you were tracking the market between this duration, that is 2004 March, something like this. I was a student back then, but obviously I was tracking markets very closely. And I remember repeatedly there were phases. If you look at the peak of Jan 2005 to this point, index went up, then couple of weeks it had massive correction, again came back to this particular point. So it may seem that over a period of 18 odd months the market did nothing. You take this peak, 4th October 2005, and take this period, June 2006. Again, the market is at the same point where it was 12-13 months back. But in this period there were massive movements happening. Again, look at this peak. Look, 18 months down the line, market is same here. But if you were not doing the process of cutting losses when the market started to correct, again started to look at market when it started to form higher high, higher low structure, breadth improvement, you will never capture the potential movement that comes in the market. At this point, do you think the news flow would be great? It would be pathetic. But if this pathetic news flow is considered as the truth, the ultimate truth, you will never capture this. You have to take information as it comes. So let's say one of these stocks, you capture a really solid trend. Let's take silver only, for example. Let's say you caught a massive trend in silver, up 30, 40, 50%. Same thing you do with a couple of stocks, maybe in auto sector, defense or finance or banks or anything. When the stock runs up 30, 40, 50%, at least pull off 25, 35% position. Take some money home. It is that kind of a market. Especially if you are that kind of a participant who feels really bad if the stock first moves 40% higher and then comes back to your average buy price. If you feel really bad because of this, you have to lock in at least 35-40% profits when the stock moves up 35-40%. If you are that kind of a participant who's not bothered about this and who wants to identify a couple of 2-3 massive winners over the next 2-3 years, then of course you should do nothing. But it will start with how you define yourself. And that is so critical. And it's going to be so critical in this market for the next 18 months also. I don't think that this market is going to be without volatility. I think plenty of volatility is coming our way. And that is why I'm making one separate video on this. The risk that is there in 25, 26, 27, there is some substantial risk that are currently brewing, not in our system, but abroad. And those risks will have to be understood by investors and traders. Else you will sell here and you'll buy here. This you will keep repeating. Whenever for the next 18, 20 months, the market corrects, you will have to have an approach of starting to look at opportunities whenever price starts to fall a lot. Look at what is falling less. Look at which sector is showing strength and then build your positions. So in my view, there is definitely more upleg that is visible in banks, in finance, in autos, in consumption. But from a risk reward point of view, so these were sectors where continuation will happen. If you have not built positions in these sectors and you want to build it today, you'll have to be a little nimble footed. But pockets that still have a lot of risk reward would still be defense, would still be capital market. It would be something like infrastructure. And if you understand and trade the oil and energy space, these are 2-3 pockets where I see risk reward is certainly there. But strength wise, the pockets that we all have been discussing over the last 2-3 months, it is still the same. The strongest sectors of markets are still banks, finance, hospitals, something like autos and consumption, which has started to move up a lot. This is the strength pocket. There are certain custom index, if you can make, you should do it, which is the rare earth index. A lot of companies, mainly government-owned companies, are going to come in that index. So that is also an index that you need to look at. There are a handful of companies. I think I could identify only potentially 8 companies that are there that can be a rare earth play. This is the theme these days. So look into that also. But yeah, from risk reward perspective, it has to be defense, it has to be oil ETF, it has to be infrastructure, it has to be capital market. So this is what I see in the market. Overall, there is nothing wrong in the market except that we are getting exposed to more and more global risk, which is something I'll certainly cover next week or maybe one after that. But be bullish. Be bullish. Bullish does not mean a 10% correction cannot come. Bullish means that at any given point in time, you have risk management in control. You know where to exit positions. You know when to step on the sidelines if things were to go really wrong. And then when you know when to enter again. That is what being bullish means. All right. So have a great weekend ahead. Take care and be safe.